Welcome back to Investing Talk Podcast. Today we're taking on a question many of you have asked. Is MannKind a good time to buy now? We've gathered, quite a stack of recent analyses, SEC filings, market data, really trying to explore this company from all angles. Our mission today is to distill the most important insights, give you the full picture, and help you understand what's really happening with MannKind. And before we jump in, if you're finding these analyses valuable, please remember to subscribe, like, and comment. We love hearing your thoughts. Oh, and if there's a specific company you'd like us to look into, definitely leave a comment below.
Yeah, absolutely. And with MannKind, it's a really complex picture. You're combining strong signals of growth with some very significant financial considerations. So we'll break down the fundamentals, the technical indicators, and what the latest news and analyst views are telling us about this intriguing biotech story.
Okay, let's unpack MannKind's core business then, and their recent performance. Our sources consistently highlight their main product, Afrezza, that's the inhaled insulin, right? And their Technosphere platform.
Exactly. Those are the twin pillars. Afrezza for treatment, Technosphere is the underlying delivery technology.
And looking at their 2024 full-year revenue, the reports state they pulled in $207.2 million. That's a 31% increase year over year. Pretty impressive jump.
It is, yeah. And that growth was primarily driven by increasing Afrezza sales and also revenues from their various collaboration agreements. But what's fascinating here, despite that impressive double-digit revenue growth, MannKind recorded a net loss of $54.3 million for fiscal year 2024.
Okay, so it's still in the red.
Still in the red. Now, that loss was narrower than the prior year's $76.3 million, which, that's a positive trend, but it still shows the challenge of scaling a biotech. On the positive side for their core product, gross margin on product sales remained robust at approximately 71.6%.
Right, so strong margins on the actual product they sell.
Exactly. So you have this intriguing paradox. Significant revenue growth, strong product margins, but persistent overall losses.
Yeah, this growth at a loss situation, it's not exactly uncommon in biotech, is it? All that R&D investment.
Not at all. Innovation requires heavy investment. For MannKind, it highlights that while they are expanding their market reach and product uptake, they're still heavily investing in R&D, market penetration, operational costs. The real insight here for you, our listener, is to understand if this cash burn is a calculated investment with a clear, foreseeable path to sustained profitability, or if it's maybe a symptom of a business model struggling to turn that top-line growth into bottom-line gains.
Okay, so what's the outlook then? Management guided towards continued double-digit revenue growth in fiscal 2025.
They did, largely reliant on Afrezza uptake and expanding partnerships like Vigo, that's the wearable insulin delivery system, and Tavaso DPI therapy, the dry powder inhaler for pulmonary arterial hypertension.
So those collaborations are key for diversification.
Crucial. But, and this is important, they don't expect sustained profitability in 2025. Ongoing R&D expenses and integration costs from an upcoming acquisition are cited, so the investment phase isn't over.
Right. Management's confident about growth, strong signal there. But for that growth to matter, we really need to look under the hood at the financial engine, don't we?
Absolutely. An engine can hum beautifully, but if it's running on fumes, that's a different story.
So this outlook directly impacts the urgency around their financial health, their sustainability.
Indeed, and it raises that critical question about how well capitalized they are for this planned expansion and ongoing investment. Our sources tell us MannKind ended Q2 2025 with about $111.7 million in cash and equivalents.
Okay, $111.7 million. That sounds like a decent buffer on the surface.
It does, but then you flip the page, look at the other side of the ledger. Long-term debt stood at $180.4 million as of June 30, 2025.
Oof, more debt than cash.
Yep. And they still carry material outstanding convertible debt and lease liabilities too. So that debt picture is something investors definitely need to watch.
And the cash burn, how's that looking?
Well, their operating cash flow was negative $21.4 million for the first 6 months of 2025.
Still negative then?
Still negative. Now, it is an improvement from negative $27.2 million in the prior year period, so the burn rate is slowing slightly. But they're not yet generating enough cash from core operations to cover expenses.
That negative operating cash flow, even improving, has got to be a significant concern. How much runway does that actually leave them?
Well, if you connect this to the bigger picture, their current cash runway covers an estimated 18 to 24 months of operations. That's assuming expenditures stay roughly the same, sort of status quo.
18 to 24 months in biotech time that's, well, it's finite.
It is. Liquidity absolutely remains a key risk factor, especially if that projected revenue growth maybe underperforms or if R&D costs ramp up unexpectedly. This situation often leads to, further fundraising. That can mean dilution for existing shareholders. It's a tightrope walk.
Okay, let's pivot now to the competitive landscape. Afrezza competes directly with injectable insulins from the big pharma players, right? What's their unique selling proposition there? And what are the hurdles they face against these established giants?
Right. The Technosphere inhaled delivery platform is MannKind's unique weapon. The insight isn't just that it's different, it's how difficult it can be to convert patients and doctors accustomed to daily injectables, even with potential benefits. This platform offers differentiation, sure, rapid-acting, non-injectable delivery. And partnerships, like the one for Tyvaso DPI, are proving crucial for medium-term growth and diversifying revenue.
But they're still heavily reliant on Afrezza, aren't they?
They are. Reliance on that single core commercial product for a big chunk of revenue, combined with, frankly, limited bargaining power with payers that really constrains their competitive position.
Meaning pressure from insurance companies.
Exactly. Razor-thin margins sometimes, intense pressure to constantly prove superior value or efficacy. It's a relentless uphill battle against competitors with much deeper pockets.
Now, here's something that really caught my eye, the acquisition of SNEC Pharmaceuticals, announced back on August 6th, 2025. What's the strategic play here? What does this mean for MannKind?
This is a very calculated strategic move. It's expected to broaden MannKind's product base significantly, moves them beyond just inhaled therapies into subcutaneous furosemide for heart failure patients.
So a different delivery method, different therapeutic area.
Precisely. Subcutaneous furosemide is essentially a self-administered injectable diuretic. It offers a new treatment option outside the hospital setting for a large patient population. It's significant because it lets them enter a new, large market, reduces that over-reliance on inhaled drugs, diversifies their focus.
Makes sense strategically. But what about the financials of the deal?
Well, it's viewed as accretive to the top line, meaning it should add revenue pretty quickly. But it's likely to be dilutive to earnings per share initially. Integration costs, deal structure, that's pretty typical.
So success hinges on execution.
Absolutely vital. Successful commercial execution and, crucially, a seamless integration of SMARC's pharmaceuticals. That's what will determine if the strategy pays off long term. It's a big bet.
Yeah. Okay, let's shift gears again. Let's look at the stock's recent price action. Our sources indicate that over the past month, shares have traded between $4.77 and $5.98, closing around $5.54 on September 5th. Relatively tight range.
It is, yeah. And when we drill down into the technicals, near-term support for MannKind is seen between about $4.60 and $4.80. That's where buying interest has historically stepped in.
And resistance.
Overhead resistance lies at $6 to $6.20. It's proven to be a ceiling. The stock hasn't broken above that level since July 2025.
Staying below suggests sellers are still active up there.
Exactly. Limiting upward momentum for now.
What about the indicators? The 50-day simple moving average is around $5.20, 200-day SMA below that at $5.04, RSI near 56. MACD line crossing above signal early September. What does all that tell us?
Okay, so putting those pieces together, the mild positive bias from the 50-day SMA above the 200-day indicates some short-term strength, but that flat, long-term slope of the 200-day suggests the market isn't seeing a strong, sustained upward trend yet.
And the RSI?
RSI at 56, just hovering in neutral territory, tells us it's neither overbought nor oversold. No immediate pressure from extremes there. And while the MACD signal crossing is a whisper of bullishness, it's definitely not a shout.
So for our listener, what's the takeaway from the charts?
It means the technical picture suggests moderate volatility, a lack of a strong directional trend near term. There's some momentum, but it's not signaling an explosive move either way. Implied volatility is around 38%, indicating some expected choppiness, but nothing extreme. Essentially, the market seems to be in a wait-and-see mode, cautiously observing rather than aggressively buying or selling right now.
Okay. Beyond the Pharmaceuticals acquisition, which we've covered, have there been any other major pipeline setbacks or big regulatory news recently?
Not according to our sources, no significant negative news on that front, which is good. However, looking at analyst sentiment, the first source highlights ratings from September 2025 showing an average hold rating.
A hold. Okay. Price targets.
Ranging from $6 to $7. So these analysts see the promise, in the pipeline, the Technosphere platform, but they clearly caution on the high get levels and those execution risks we talked about.
That hold rating gives one perspective. What about insider activity? Are executives buying shares, showing confidence, or selling?
Well, there were several Form 4 filings in July, August 2025 showing routine sales by executives, including the CEO, Michael Castagna, and CMO, David Thompson.
Routine sales meeting.
It's important to note these were mostly automatic vesting of performance shares, not open market purchases where they're actively deciding to buy. So it looks like typical executive stock management, not necessarily a strong signal either way.
And retail sentiment. Social media buzz.
Low to moderate buzz. Sentiment seems mixed. Some retail investors are bullish on the Skake Pharmaceutical synergy. Others are definitely bearish on the potential dilution risk from financing needs.
But interestingly, that mixed picture, the cautious hold ratings, it seems to clash with other analyst views.
It does. On the flip side, the second source we looked at mentions analyst upgrades and some pretty bullish outlooks in September 2025 from several firms, initiating or reiterating buy ratings.
Buy ratings? With what kind of potential?
With price targets suggesting up to 100% upside potential? Quite a difference.
Wow. What's anchoring that optimism?
It seems anchored in MannKind's expansion plans, the advancement of late-stage assets like MNKD 101. Also, institutional interest apparently increased in August with notable buys from some healthcare-focused funds.
That's a really wide divergence in opinion. How do we reconcile those bullish 100% upside targets with the holds and the debt concerns?
Yeah, this divergence is absolutely key for investors to understand. The bullish outlook, particularly from that second source, seems to be placing a much higher probability on the successful execution of MannKind's expanded pipeline, especially late-stage assets like MNKD 101. They might be modeling a more rapid, more successful commercial scale-up of SEC Pharmaceuticals products, seeing a quicker path to profitability, perhaps.
And giving more weight to the platform itself.
Exactly. Giving more weight to the potential of the Technosphere platform beyond just Afresa. Viewing it as a valuable asset that could unlock significant value through future partnerships or new products. The institutional buys also signal a belief, among some larger players, that the long-term potential outweighs the near-term financial challenges.
So it's a fundamental split.
It really is. The buys are betting heavily on innovation and future pipeline delivery. The holds are focused more on the current financial realities, the debt, the cash burn, and the inherent execution risks in a tough biotech landscape. Growth potential versus present-day financial stability.
Okay, let's look ahead then. What could move the needle for MannKind? Short-term catalysts investors should be watching.
Short-term, definitely the pharmaceuticals deal close itself. That involves navigating shareholder approvals, antitrust stuff, integration milestones expected in Q4 2025. How those initial steps go is critical.
And earnings.
Yes, the Q3 earnings release, likely early November 2025, that'll be significant. Investors will scrutinize revenue growth progress and, crucially, that cash burn rate. Also, any new formulary wins or coverage expansions for Afresa in key markets would provide a much-needed boost, shows market acceptance.
Makes sense. And looking further down the road, long-term catalysts.
Long-term, it really centers around their innovation pipeline, progress in the expanded Technosphere pipeline beyond Afresa, success in developing new therapies using that platform would be a game changer. Continued growth from the Tyvaso DPI royalties via their United Therapeutics partnership, that's a steady long-term driver.
And the big acquisition.
Most importantly, yes. The successful realization of cost and revenue synergy targets post-Skake Pharmaceuticals acquisition. That will be a huge indicator of whether that strategic gamble really pays off. Oh, and the second source also specifically mentioned potential binary catalysts, like an accelerated MNKD 101 Phase 3 data release. Positive clinical trial news could really move the stock.
Right. But with catalysts come risks, especially in biotech. What are the primary risk factors we need to highlight for MannKind?
Yeah, this is where the rubber meets the road. Stock-specific risks definitely include those ongoing operating losses and the persistent cash burn we discussed. That naturally leads to high R&D spend. And that cash demand means there's always a potential need for equity or debt issuance, which could lead to further dilution for existing shareholders.
What about market risks?
There are inherent regulatory and commercial risks for Afresa in its competitive market. They're up against huge, well-funded competitors. And the uncertainty around the successful execution and commercialization of the SEC Pharmaceuticals integration, that's a massive factor. Acquisitions are notoriously difficult.
Plus the sector itself.
Exactly. MannKind operates in a high-volatility biotech sector, and general drug pricing and reimbursement policy changes, always a political hot potato, could significantly impact their future revenue and profitability. Lots to consider.
Okay, bringing it all together then. The overall investment rating from our first source was a 4 out of 10. So what does this really mean for you, our listener, considering this stock? Why such a middling score, especially with those bullish targets floating around?
That 4 out of 10 rating reflects a balanced, maybe somewhat skeptical view. The positive aspects are certainly compelling, you can't ignore them. Double-digit revenue growth, the potential in their unique Technosphere platform, the
Yeah.
long-term optionality from the Skate Pharmaceuticals acquisition, diversifying their portfolio. But these opportunities are heavily counterbalanced by those persistent operating losses, the very real liquidity constraints, the high debt burden, and the significant risk of further dilution if they need to raise more capital. The technical indicators show a largely neutral trend right now. Sentiment is mixed. It's not signaling a near-term breakout. And heavy execution and integration risks truly dominate the near to midterm outlook.
They're making big moves, but the landing isn't guaranteed.
Exactly. Far from guaranteed.
So for short-term trading, it sounds like MannKind isn't particularly compelling right now. Lack of strong volatility, mixed news.
Generally, yes. Not much pointing towards a quick pop based on current technicals and news flow.
And for long-term investment, someone looking to hold for years.
For long-term investment, MannKind carries high risk. There's certainly potential for significant upside, as some analysts suggest, absolutely. But that upside hinges entirely on the pipeline truly delivering on its promise and on their financial discipline improving dramatically. The analysis rates that probability as moderate to low at present. That's a key takeaway.
So not for everyone.
Definitely not. It's generally not suitable for most long-term investors unless you have a very high risk tolerance, you're comfortable with biotech volatility, and you possess deep conviction in MannKind's platform and strategy to overcome these financial hurdles. Even the bullish source emphasizes that sustained upside hinges critically on pipeline execution and successful commercial scale-up. High reward, high risk, certainly not for the faint of heart.
Wow. What an insightful analysis of MannKind. We've certainly seen a company with promising growth and some bold strategic moves, but also significant financial hurdles and execution risks that demand really careful consideration.
Indeed. It really highlights how crucial it is to look beyond just headline revenue numbers. You have to consider the full financial picture, the cash burn, the debt, alongside the competitive landscape, the strategy, future catalysts, all against the backdrop of inherent risks in this dynamic sector.
So what stands out to you from this discussion? How do you weigh that growth potential against financial stability and execution risk, especially in a sector like biotech? Definitely something to mull over as you consider your own investment strategies. Thank you for joining us on Investing Talk Podcast. We hope this analysis has given you a clearer, more nuanced understanding of MannKind. Until next time, keep learning, keep questioning, and keep investing wisely.